Very good.
All right, so welcome everyone. This is the first of 4 webinars that we're hosting here at SeaCure Advisors around the topic of Social Security. Thank you so much for taking time out of your busy day to join us as I get windows popping up all over my computer. Perfect timing. This is actually a good opportunity to mention that we are kind of new at the webinar game. I think as financial planners, we do some great work here at SeaCure Advisors, but as webinar hosts, we're good financial planners, and I'll just leave it at that. So just thanking you in advance for your patience and forgiveness if we have any technical issues today. So my name is Jonathan Howard. Also Carolyn Howard, my mom / CEO, is on the webinar today. I'll be presenting the information, and Carolyn will be taking your questions in the chat. So if you do have any questions, please throw them into the chat window down there. You can also use the Q&A that you should be seeing down at the bottom of the Zoom window. And we'll get to those questions at the end of the webinar if Carolyn is for any reason unable to answer them by typing while the webinar is going on. So in terms of what we're covering today, we're going to be looking at some broad strokes regarding Social Security. Before I came over to financial services, I was a visual effects artist. This right here is a shot from a Walmart commercial that I worked on many years ago. And even though I didn't know anything about retirement planning and retirement income planning and all the stuff I've had to learn as part of my certified financial planner coursework over the years, I still had opinions about Social Security. The general going wisdom was that I should just assume it's not going to be there for me by the time I retire. Now, what's interesting is as a CFP, we're required to every single year do some continuing education and just keep our skills sharp. And so knowing that this is a topic of great interest to a lot of our clients and the people that we meet with, we decided to do our continuing education most recently on Social Security and Medicare. And the workshop that we attended was hosted by a woman in her 70s who's been a planner for about 3 decades. And when she started in the business, she had heard the same thing that I did just a handful of years ago, which was that you should assume that Social Security is not going to be there and start retirement income planning with the assumption that it's not going to exist, that Social Security will not exist. Well, she's in her 70s now. She's actively claiming Social Security. And I think, I like to look at this as like an empty glass. And that glass can be filled with water, which is knowledge and evidence and real numbers, or it can be filled with air, which is the same as superstition and hearsay. And retirement income planning, especially around Social Security, involves some decisions that can be with you for the rest of your life. So once you get past age 70, there's no changes that you can make to your Social Security strategy. So it's really important to, as they say, stick the landing on this and use evidence, use real knowledge and not hearsay and superstition. So that's what we're here today to do, is to fill up your glass with knowledge so you can go into these decisions confident that you're making the right decision for you, because there's as many correct decisions out there regarding retirement income planning as there are individuals. So as far as what our process is, and just have a couple things to get out of the way before we start in on the presentation today. As far as our process, you're going to see as we go through the presentation today, a link in the lower left corner of every single slide. And don't worry, you don't have to write it down. Everyone who attends the meeting today will get a copy of the slideshow so you can review this at your own, on your own time. But that link will enable you to have a phone call with us. And from that phone call, we can get to know each other. Obviously, there's some folks on the webinar today I see that we've already met with before, which is fantastic, and a couple folks who are active clients. Obviously, that phone call might not be necessary, so we can go straight to a meeting about Social Security if you like. But for folks that we haven't met with yet, that introductory phone call will give us a chance to get to know each other and understand what kind of value we might be able to bring to the conversation and what we can cover in a 90-minute complimentary session together. And in that complimentary session, which everyone who attends this meeting will be entitled to, you're going to get a few things. We're going to be able to give you this handout on the Boomer's Guide to Social Security. It covers in some detail some of the concepts that we're going to be addressing in a general way today. And you'll also be able to get, you're also going to be able to get this report. This is an example of one of the reports that we give to our meeting attendees. This is a break-even report, which shows for me, I ran this for myself, the age at which I would break even by waiting until 70 to claim my Social Security versus starting early at 62. So that's one of many reports that we can give you. And with that, I'm going to start the screen. I'm going to share my screen so we can go over a couple of things that will be helpful in today's conversation. So I encourage everyone on the meeting today, on the webinar today, to take a look at our websites, at the SeaCure Advisors website. On our website, you can click this resources button. And if you could actually throw up into the chat, make sure that you're seeing my screen here, that would be super helpful. It says here that I'm sharing my screen, but I always like to double check with folks. So there is this really helpful website that we put together for retirement and largely income planning. And there's a flow chart that you can use to help determine whether or not your Social Security benefit will be reduced either by claiming early, or if you're still working, how much your benefit might be reduced by. And we're going to be covering those things today, but I just wanted to let you know right out of the gate, there's some free resources on our website for you. And with that, we can get going. So let me fire up the old presentation here. So this is the first of 4 webinars. They're designed to stand on their own, so please don't feel any obligation to watch all 4. Also, they are going to be available on demand. So if you're not able to watch the other 3 when they're scheduled, which is this coming Thursday and then next week, Tuesday and Thursday, you will be able to watch these on demand at your leisure. We also have some beautiful disclosures here for you. Just going to give you a chance to soak these in, let them percolate, and they're very nice. And with that, here we go. We're going to try to get through this now in about 30 minutes, and then we're going to have some questions and answers at the end. And Carolyn obviously will be here throughout the presentation to be able to answer your questions as they come up. So just use the chat window or the Q&A button at the bottom of your screen. So a lot of people tend to underestimate the value of Social Security. And that was certainly true for me before I started my own career in financial services. And a lot of folks assume it's going to be a fairly minimal amount and not enough to make a real big dent in their retirement planning. In fact, last year, 2020, Motley Fool, which is a really excellent financial website, came out with an article with some research that showed that, that about 64% of all retired seniors actually depend on Social Security for more than half of their retirement income. So when we're talking about Social Security and retirement income planning around it, it's very, very important to, number one, just understand that it will be there and that it's going to probably be, for most of you, a very big part of your retirement income planning. And so let's take a look at what this means in real dollars. So just hypothetically, if your monthly benefit is $2,000 today and you live 10 more years, what that means is that you will have received $276,000 and some change in total benefits. And these numbers, by the way, assume a 2% annual cost of living adjustment, which is what the Social Security Administration recommends that you use. This past year, I believe it was actually 1.3%. So it does vary. And in our own planning, we adjust that down to 1.5% just because we like to stress plans out and make sure they can withstand lower returns and lower inflation adjustments to income. So after 20 years, you're looking at over $600,000. And after 30 years, you will have actually lived, if you live 30 years past your Social Security claiming date, you will have received over $1 million in benefits over that time. And in terms of how that breaks down as far as what your monthly check will be from Social Security, and obviously this is pre-tax and pre-Medicare Part B premiums, which are deducted automatically from your Social Security check. If you start with $2,000 and you have a 2% cost of living adjustment, in 10 years, that $2,000 payment will have turned into $2,438. And if you look all the way out 30 years in advance, you're going to be looking at $3,623 every single month. And this is, and it keeps on going up each and every year, assuming there's no changes to the Social Security system as it is now, which I know is unlikely, but for the majority of people, especially retirees and baby boomers who are going to be claiming in the near future before any changes are likely to be implemented, you can expect your benefits most likely to remain as they are, although there's no guarantee on that. I think, we've been dealing with government distrust and institutional distrust a lot lately. And I think you would see an all-out revolution in the United States if Social Security was taken away, simply because there's so many people who depend on it, like I said, for more than half of their retirement income. So I think I'm actually very bullish on Social Security. I think it's going to be there for a good long while. So how is your benefit going to be calculated, and how much are you going to receive? This is going to primarily depend on two factors: how much you earned over your working career and at what age you apply for benefits. So how Social Security benefits are calculated. This is going to get a little bit nerdy. I apologize. I'm a huge nerd. You kind of have to be a visual effects artist, and I've ported my nerdiness right over into financial services. So we're going to take a little bit of a look under the hood here. So you can take a nap right now if you like, but we're going to discuss some nuts and bolts. At age 62, each year's earnings are going to be tallied up and indexed for inflation. But which years? Well, it's going to be your 35 highest earning years. So if you have any zeros in there, so for example, with women, and we do have a special webinar specifically for women in Social Security, a lot of times women have taken years off of work to care for family members, either children or aging parents. And this is a burden that falls heavily on women. And so a lot of times they'll have either reduced income or even 0 years in their earnings history. And it doesn't matter, the Social Security Administration, they're going to look at those 35 years of earnings, and there could be some zeros in there. And what they're going to do is they're going to take those 35 years of earnings, they're going to index them so that the oldest earnings, the ones that happened longest ago, will be indexed to come up with some kind of present day value. And then all of those earnings will be tallied up and divided by 35. And that's going to give you your AIME, which stands for average indexed monthly earnings. And that's going to then be divided by 3 bend points, which are going to be used to determine your primary insurance amount. And that primary insurance amount is effectively just the amount of Social Security benefits that you would receive if you waited until your full retirement age. For me, that's age 67. So your benefit is then going to be increased each year by cost of living adjustments, which vary each year. They have an index that they track. This year, like I said, I believe it was 1.3, but it's been in the past, sometimes even over 2%. So let's take a look at an example of what the benefit formula looks like. So this is going to be an individual born in 1959. And we're going to assume that this person is a bit of an outlier. And every year since the age of 22 has earned the maximum amount that you can earn as far as a contribution to Social Security. You can look at your W-2, and you'll notice on your W-2, there's a special box for Social Security and Medicare. Social Security wages and tips. And basically there's a ceiling beyond which you're not going to be contributing anything to the old age survivorship disability insurance program, which is the Social Security part of FICA. And I believe that number, I don't have it off the top of my head this year, it's a little over $140,000. If you earn, let's say $180,000 on your W-2, a portion of that money will actually not be going into Social Security, but that's getting down a rabbit hole. The bottom line is this person has an AIME, so their 35 highest earning years indexed and then divided by 35 equals $11,098. And so now we got to apply those bend points. So the first bend point is going to be at $996, and that's going to be multiplied by 90%, and that's going to give you $896.40. And then you're going to get to the second bin point. So after $997 all the way up to $6,002, which is a $5,006 window, we're going to multiply that amount by 32%. And that's going to give us a second number that we're going to be using to tally the primary insurance amount. And that last bin point is simply the remaining portion of AMI, which in this case is $5,096. That's going to be multiplied by 15%. And then all these numbers are going to be tallied up, and we're going to get $3,262.72. And that's what this individual's full retirement age benefit or primary insurance amount will be. And the point of these bin points is to make sure that Social Security is benefiting lower income earners the most. So that first roughly $1,000, and these bin points do change every single year. They're indexed every single year. That lower portion, that lower third, that first bin point is designed to maximize the benefits for lower income earners, so that people who've been earning more income for their entire life, likely contributing to retirement accounts, 401ks, and so forth, they're going to get less of an overall benefit as far as their Social Security income is concerned, relative to what will hopefully be their overall retirement income strategy. So Social Security is designed to benefit lower income earners first and foremost. So let's go over some terms. Full retirement age, it means different things to different people, depending on when you were born. So everyone born before 1954, your full retirement age is going to be 66. After 1954, we're going to add 2 months every single year until we get to a birth year of 1960. And so for everyone born 1960 or later, which is me, your Social Security full retirement age will be 67. And it's interesting, there was a Social Security solvency crisis, going back to this issue of will Social Security be there for me? There was a solvency crisis back in 1983. And these full retirement age numbers were designed back then to help address the solvency crisis, and they solved it back then. Nowadays, if you look at your Social Security statement, and I have mine right here as an example, there is some actual language in here. I can see if I can find it. Nope, I can't find it right off the gate here. But, oh no, here we go. By 2035, the payroll taxes collected will be enough to pay only about 79% of scheduled benefits. So by 2035, there is projected to be another solvency crisis, but there already is legislation that's on the table that I've talked to CPAs about it. They seem to think it's very reasonable and fair. It generally impacts people who earn more than $400,000 a year. It might be looking at measures like changing the full retirement age again, pushing it a little bit later, which isn't the worst thing because people are living longer. But the bottom line is, we've been here before. We've been at a crossroads before where there was some concern about Social Security, and it was solved. And I expect it to be solved again. So a lot of folks, a surprising number of people that I meet, not just at work, but just in casual conversation, when Social Security comes up and retirement comes up, the going thinking for a really striking number of people is that you're just going to claim it as early as possible. Age 62, I'm going to start taking my Social Security check. But there is going to be a reduction of benefits. So a lot of people like the idea of being early for something, but when you apply for early benefits with Social Security, you're actually going to get a reduction of benefits. So if your full retirement age is 66 and you claim it's 62, you're actually going to get a 25% reduction in your overall Social Security benefit, and that will never go away. That is going to be a 25% reduction for the rest of your life, which is actually going to be compounded by the fact that your cost of living adjustment will be multiplied against a smaller number, and can be further magnified by the fact that if you're the higher earning spouse and you predecease your spouse, your decedent spouse is going to, or your surviving spouse is going to claim your survivor benefit, which will be lower than it would have been had you waited till your full retirement age or later. And if your full retirement age is 67, you're going to get a full 30% reduction off of your full retirement age benefit by claiming at age 62. So I'm not saying that this is wrong. For some people, this is an absolute necessity, and there's no way around it. For other people, it might actually be a good strategy because they don't need the money and they can invest it and can start growing it And as we know from investing, it's all about time in the market, not timing the market. So the longer that money can be in the market, the better. So there are some situations where claiming early actually makes sense, and we can show those to you with our reports. But for a lot of folks, it's actually going to have a lifetime reduction of retirement income. Now, what happens if you wait? So if your full retirement age is 66 and you wait until age 70, beyond which you're not going to get any more delayed credits, which is, it's funny, the federal government sort of incentivize people strangely here, because most people don't like to delay things. They don't like to be late. However, in this case, delaying earns you 8% every single year of annual credits that will increase your Social Security income. So if you're age 66 and that's your full retirement age, if you wait till age 70 to claim your retirement benefit, you're going to see a 32% total increase in your retirement income from Social Security. If your retirement age is 67, like me, your age 70 benefit will be 24% greater than it will be at age 67. And this then, like I said, has a ripple effect because your cost of living adjustments will be multiplied against a larger number. And then also, if there's any survivorship benefit that I pass on to my spouse, she will get a larger benefit as a result of my delaying having claimed Social Security. So how can you estimate your own Social Security benefits? I'm going to end the slideshow really quickly. I'm just going to pause it and I'm going to show you, I'm going to screen share. Oh, looks like I'm already screen sharing. This is the Social Security website. You can go on here and do a bunch of stuff. You can create your own account with this My Social Security link right here. And if you can create an account or sign into one you already have, and that will give you access to your Social Security statement, which will show your primary insurance amount or your full retirement benefit right at the top here. And that is extremely useful when we're running analysis and generating our own reports about different scenarios. You can also, let me back this up. You can also use their retirement estimator, which is basically some online planning calculators that they have on the Social Security website. Now, you have to be very clear about something. The Social Security Administration is very helpful on a number of levels. Where they are not so helpful is in planning. They can tell you how much you will earn in Social Security monthly income at certain ages, or if you're dealing with survivor benefits, what your benefit might be, or if you're a divorcee, what your divorce benefit might be. But they're not going to be able to actually run scenarios for you. They're not going to be able to do any planning for you, which is where we come in. So if you do have planning questions, the Social Security office has some great resources for you, but for actual planning work, you really need to talk to a professional. And I highly recommend, if it's not us, speaking with another certified financial planner. And we have some resources that can be extremely helpful in giving you the information you need to be able to make a decision confidently. So I'm going to go back to my presenter view here. So when you are considering what factors you are, or when you're considering your Social Security claiming strategy, here are the factors that you should be thinking about when making this decision. Number one is health status. A lot of Social Security and retirement income planning is fundamentally going to be based on your life expectancy, which is the second point here. Life expectancy in general, we're looking at how long your parents lived. And that's going to give us a pretty good idea of your own life expectancy. But your health status is really step one. If you're in good health and you expect to live a long time, fantastic. We can project out your Social Security income for a good long while. And if not, we can use that assumption and truncate the length of the planning that we need to do. And that does change some things as far as medical expenses that will need to be accounted for, and break-even points for different Social Security claiming strategies. Also, your need for income. How much retirement assets do you have? And how much income can be pulled from those versus how much will need to be dependent upon, how much will you need to depend, excuse me, on Social Security? Are you going to keep working? If you're planning on claiming early and you still plan on working, there is going to be a reduction of benefits. Our fourth webinar gets into that in some detail. It's not a permanent reduction, and we're going to talk about that a little bit today, but it does need to be taken into account when you're constructing an income plan. And then, of course, we need to think about survivor needs. And if anybody in your family, a spouse, for example, might get survivor income from Social Security, should you predecease them. So some key points to remember. If you apply early, your benefit starts lower and stays lower for life. Once you reach age 70, if you've already made an early filing decision for Social Security, there's nothing that can be done, and you're locked in for life. So this is an extremely important decision. Cost of living adjustments are going to magnify the impact of early or delayed claiming. The longer you live, the more beneficial it is to delay benefits, because those cost of living adjustments will give you a compounding return. And obviously the decision is going to impact survivor benefits as well. And so delaying benefits is that will have the primary utility of passing on a higher income stream to your surviving spouse. So let's take a look at some claiming strategies for as far as maximizing your benefits. Number one, can you improve your earnings record? If you're looking at me at home here, I'm going to be holding up my earnings record very briefly. So you can see that I've got 35 years, and some change. It starts in 1993 for me and goes all the way up to 1999. I'm sorry, 2019. My brain's not in the 21st century yet, evidently. Anyway, 35 years. If there's any 0 years in there, can you still work and increase and get rid of some 0 years and add some non-zero years there to increase your benefit? Also, if you have paperwork that goes back a number of years that you can show how much you contributed to Social Security, or what that W-2 box was as far as your Social Security wages and tips. And I don't expect people to maintain records for 35 years, but you might find an error on your Social Security earnings record, and you can get that corrected. I will say that that's not going to be a strategy for the overwhelming majority of people, both because of record keeping and because this is all coordinated with the IRS, and it's very, very rare. I've never seen an instance of it actually where there has been a mistake on the Social Security earnings record, but it is something to be aware of and to take a look at for sure. So next thing, are there any missing years? And you just make sure that if there is a 0 year, that you can look back at your earnings and confirm whether or not there should be a 0 there. That is an absolutely gigantic mistake if there is a 0 in that 35 years of earnings. So if you plan to apply for Social Security while you still work, because if you are going to apply for Social Security and also try to change some 0 years in your earnings history to years where you have some earnings, there's going to be some repercussions. Namely, before the year before your full retirement age, all the way up to age 62, $1 in benefit will be withheld for every $2 you earn. And that's going to be over $18,960 in modified adjusted gross income. What is modified adjusted gross income? That is basically your adjusted gross income. You can look and see what that is on your taxes and simply add in any income you receive from municipal bonds. And that will be your modified adjusted gross income in terms of your Social Security calculation. So benefits will be withheld, but then when you reach your full retirement age, your benefits are going to be adjusted, and they're going to be adjusted upwards. So this is not a permanent reduction in benefits from still working. If you are still working while claiming Social Security before your full retirement age, they will adjust your benefit to basically put that money back into your Social Security check. So it's not a permanent reduction. They're just withholding it while you're working. So the main takeaway here is do not let this annual earnings test, which is what this is called, do not let this discourage you from working. But if you are, confused by all this and just don't want to have anything to do with it, simply wait till your full retirement age before claiming benefits. Also, I do want to say that the year before you reach full retirement age, it's going to be $1 in benefits withheld for every $3 you earn. But like I said, that's not a permanent reduction. It will all come back to you once you reach full retirement age. So strategy number 2 for maximizing your benefits, apply at the optimal time. That is going to be different for each and every person. This is going to be based on your income needs, your life expectancy, your spouse's life expectancy, and a whole host of planning considerations. We really like to start all of our conversations and engagements with people on with a comprehensive look at your financial picture, and retirement income is where we start for a lot of folks, but there's a lot of questions that need to be answered before we can really dial in a retirement income plan. And so what that optimal time is for your Social Security claiming will depend on a number of factors that are unique to you. Coordination of spousal benefits. This is where things get pretty complex. If you predecease your spouse and you're the higher earner, your spouse will inherit your Social Security benefit. So understanding how that works and accounting for it in your retirement income plan, especially as it comes to healthcare expenses and even long-term care expenses in retirement, is a really enormous consideration that should be considered. Strategy number 4 for maximizing your benefits. Minimize taxation. Of course, we would all love to minimize taxation, but what does this actually mean? Well, Social Security, to start out with, is already a tax advantage source of retirement income. You pay in to that old age survivorship and disability income fund, that Social Security portion of FICA. You pay into that with pre-tax dollars. So that's a tax benefit right there. And then when you get the money out, a portion of that income is going to be taxable, but not the entire thing. So up to a certain level of income, you are going to be taxed potentially at 0 on your Social Security income. Again, this is designed to benefit lower income earning people the most. And then once you reach a certain level, your benefits are going to be exposed to tax at a rate of 50%. So 50% of your Social Security benefit will be exposed to tax. It's not going to be taxed at a 50% rate. It's just that 50% of your benefit will be exposed to tax. But then for a lot of people in the middle class, 85% of your Social Security benefit, not 100, just 85% will be exposed to taxation. So even at a high earnings level, only 85% of your Social Security benefit is going to be exposed to tax, which means 15% of it is tax-free. So how can we further help this along and minimize taxation of Social Security benefits? For starters, you can reduce other income with tax-advantaged investments. One of the best ways to do this is with a Roth IRA. We have a whole hour-long presentation on Roth IRAs and Roth conversions, but in anticipation of RMDs coming from, that's required minimum distributions, coming from IRAs, what you can do is actually convert a certain amount of that to a Roth IRA, which will be tax-free forever. So you pay taxes now at these historically low rates that we have, so that you don't pay taxes and your heirs don't pay taxes down the road on that converted amount. So that is one of many strategies that people can employ to minimize taxation of retirement income. Also, using your IRA assets and drawing those down before age 72 to reduce required minimum distributions, which is the portion of your IRA that you have to withdraw every single year. By keeping those RMDs down in the future, you're going to be reducing your overall tax burden potentially. Delaying Social Security reduces the number of years your Social Security is exposed to taxation. And you can also try to reduce your expenses through paying down debt. And I don't really recommend this one, adopting a simpler lifestyle. I'm not in the business of turning all of my clients into monks and nuns. That's not my job. I like to try to help people maintain a quality of life that they will enjoy for the rest of their lives, so that they feel like they're not being constrained by their money, that their money is actually enhancing their lives. And sometimes that actually does involve a simpler lifestyle. Sometimes simpler is better. But ultimately, what we're trying to do is preserve a quality of life for people, which doesn't involve a reduction of income. However, paying down debt can be a really good strategy here. You can use taxable resources like IRAs to pay down that debt before you claim Social Security, for example, which will reduce your RMDs. And then that could reduce potentially your overall taxes when you're pulling Social Security income in addition to your retirement income stream. And then obviously each and every year, managing taxes. This is a huge part of what we do here at SeaCure Advisors. We have a lot of tools and also relationships with CPAs. We like to have relationships with every single CPA that our clients have, just so we can help coordinate taxes every single year and take advantage of any opportunities that might be there. Because what we're trying to do is pay what we owe to Uncle Sam, but not leave him a tip. So we're winding things down here. Strategy number 5 for maximizing your benefits is to coordinate Social Security with your overall retirement income plan. When we're looking at retirement income planning, Social Security is what we like to call an income floor. It is some income that will be there for your entire life that you can depend on, and that we can start building, just like, like a foundation of a house, we can start building your retirement income plan off of this income floor that Social Security establishes. And so coordinating your overall income plan in conjunction with Social Security is a great approach, and will help you maximize your benefits and ensure that you have the correct claiming strategy in place. And so what this means is that we're going to be looking at Social Security in the context of pensions, which a number of people actually have who are retiring right now. People in my age bracket look at that word and wonder what on earth I'm talking about. Not a lot of folks these days have them, but if you're a government employee or if you're working at a company which amazingly might have a pension, by all means, we need to coordinate your retirement income plan and your Social Security claiming strategy in that context. Obviously, IRAs and 401ks, there's going to be required minimum distributions off of those, as well as potentially additional distributions to fund retirement. This all needs to be taken into account. Taxable investment portfolios, brokerage accounts, for example, ESOPs, stock option plans through work, all of this needs to be taken into account. And of course, if you still plan on working, that's one of the very best ways one of the very best tactics out there for not only preserving your assets, but establishing an income floor that will reduce the strain on your assets throughout your retirement. So these are all things that need to be considered when you're looking at a Social Security claiming strategy. So you have questions, and we are here to help. So obviously, top of mind for just about everybody is, when should I apply for Social Security? What if I want to keep working? What if I've already applied? Believe it or not, if you're under the age of 70, there may be some things that you can do to increase your benefit, even though you've already applied for Social Security. How much will your benefit be under different scenarios? How can I coordinate my spousal benefits? What's the best long-term strategy for my situation? And then what do I do next? What are next steps? These are all things, among others, that you should be thinking about, that you may be thinking about already, and we can help address this, because each of these considerations is going to be, each of these questions is going to be unique to you. There's no one-size-fits-all answer for anybody when it comes to Social Security. So, like I said early on, Social Security is too important for hearsay. It's too important for superstition. It is a decision that will last you the rest of your life. So let's, make a good decision here and help protect your nest egg, the sum of money that you're going to be relying on for the rest of your life in retirement, as well as what you plan to pass on, if you plan to pass on anything to your heirs, your children and grandchildren, and also maximizing your income in retirement. Again, here's that link so that you can schedule some time to talk with us. Here's our email and phone number information for reaching out and getting in touch with us. And with that, we are at the end. So do we have any questions? I'm going to stop the screen share so you can see us in all of our glory here. Are there any questions that we can help get you through?
We have a comment from one participant thanking us for this presentation.
Fantastic. That's really great to hear.
Yeah. One of the questions that has come up is, if I wait until 70, I think my wife or my spouse, if I'm the higher income earner, and I wait until 70 to take my Social Security, will my spouse at her or his full retirement age get half of that 70 income, or is it another number?
Okay, so let me just make sure that I understand that question correctly. So the situation is this person is thinking about waiting until 70, delaying until 70 to claim.
Correct.
And they want to know, is the spousal benefit that they will be in, that their spouse will be entitled to at age 70 be 50% of that age 70 benefit or a different number?
I think the question is, if, let's say that the spouse is 70 and has delayed, and the other spouse is at full retirement age at 66. So, and that spouse have much lower income. So it's better for that spouse to take half of the other spouse's income from Social Security.
Gotcha.
So will it be half of the age 70 number, or is it another number?
Okay. Yeah, this is a great question, and it's something that we're going to be addressing in our webinar about Social Security planning for couples. We're going to be addressing this in some detail. However, you can help answer this right now. So there's a couple of factors at play here. For starters, as a spouse, I cannot, if I were the lower income earning spouse, I will not be able to claim my spousal benefit until my spouse claims his or her benefit. So you cannot get a spousal benefit until the spouse in question has already filed for their own benefit. So that's point number one. Point number two is that the spousal benefit stops increasing at full retirement age. So that 50% will not be 50% of the age 70 benefit. It will be 50% of the primary insurance amount for that higher earning spouse. That means, whatever is on the cover of your Social Security statement, divide that by 2. That's what the spousal benefit is at full retirement age. And that is the maximum amount that the spouse will receive, no matter what, no matter when the spouse, the higher earning spouse, claims it from a delayed standpoint. If the higher earning spouse claims early, then that spousal benefit will be reduced. So that's a huge thing to consider. So this does get complicated. My own benefit increases from 67 to 70, but the spousal benefit locks in at age 67 for me. That's the full retirement age, and then stays the same. And then my spouse just has to wait until age 70 to claim her benefit, at which point it would be 50% of that age 67 benefit. Really hard to articulate that in a way that doesn't sound crazy. So this is one of the reasons why we run reports for people, just so you can actually see the numbers in play and what the lifetime benefits are if you lived to certain ages and all that good information. So any other questions here?
Yeah, there's one question. If I'm required to file for Medicare at 65, can I still delay my Social Security?
Yes.
Okay.
That's easy.
Okay.
The one thing about Medicare that you have to understand is that you'll be automatically enrolled if you file for Social Security at 65. You're going to be automatically enrolled in Medicare. Otherwise, it's a manual process, and you have a 7-month window around 65, 3 months before and 4 months after, where you have to file for your Part A and get all that stuff done. That's a whole other conversation. Medicare is wild. It's the wild and woolly world of Medicare, and it does relate to Social Security, but they are separate in a lot of important ways, and that's one of them. So.
Anything else? All the questions.
Okay, perfect. Great. Well, thank you everyone so much. So what happens next? You're going to get a report card. There's going to be an email that goes out automatically as soon as you disengage from the webinar. And there's going to be a report card that you receive in email. Please do fill that out. It helps us make these better because frankly, we're kind of new at the whole webinar thing, and we want to make sure that we're providing as much value to our community as possible. And that community equals everyone who watches these things. So please do fill out that report card. We take them very seriously, and let us know what's working for you, what could be better, and we'll make those changes. So that is it. Thank you so much. And also I'll be sending out the slides to everyone who attended today so that you can take a look at the information at your own pace. And that's it. So thank you so much for attending, and Have a great rest of your day and a great rest of your week. Bye.
Bye.